This presentation shows the story of how FairShares Commons as a way of incorporating businesses can create regenerative and distributive ecosystems and how it makes the business anti-fragile. Maria and Steve started a business designing, producing and selling their own sustainable furniture line. They dream of a fully regenerative supply chain for their company. Currently, they are producing single pieces themselves on demand, and they call their company FairShares. In order to grow their business, they need funding. Ed is a pre-seed angel investor. He wants his investment to do something good in the world and leave the world a better place than he found it. He is looking for an investment opportunity in line with the sustainability goals. Ed has had some experience in the past where big investment firms jeopardized his efforts by pushing for short-term gain, and he does not want that again. Ed finds Maria's and Steve's values very similar to his own and wants to contribute. He becomes their first pre-seed angel investor. Here we split the story into two different scenarios. The blue storyline tells of a Standard Limited company. The green one follows the same events as a FairShares Commons company. On the Standard Limited side, the company is the property of the founders. Investors can buy parts of that company and hope for a positive return of investment. The explicit purpose of the company is to design and sell furniture in a sustainable way. However, implicitly, the company now needs to maximize financial profit. For Ed, it is hard to find suitable investment opportunities. He needs time to understand the business models and choose the most promising ones, and he needs to trust the founding teams. But even after all this effort, there is little to no security for Ed that his values will remain after other investors join. The FairShares Commons is a non-standard limited company. This way of incorporating is already available under most company and incorporation legislation in the Western world. There is examples of these in many European countries, the US, and countries such as Nigeria. In the setup, all stakeholder groups, not only investors of financial capital, are invited to the table, can hold shares, and are included in important decisions. Ed can reach out to a foundation he knows and trusts, and they can point him to several opportunities within their network. Ed can be sure that these are already regenerative businesses. He can trust that this way of doing business is in line with his values and will be, even after he is no longer an investor. In the Standard Limited company, Ed initially receives high power and voting rights and shares to the overall company. These will get diluted over time as more investors join the board. In the FairShares Commons, Ed can only buy investor shares. These shares have a capped voting right power. So even if Ed owns all the investor shares, he will not exceed a fixed percentage of voting power. The distribution of voting power is fixed upon founding of the company. The majority of the voting rights goes to stewards who are voted into their role. Both founders are on the stewards panel as well as representatives of the FairShares Commons Foundation. Steward shares cannot be bought or sold. If Ed trusts the stewards of the company, then he can trust that the values are upheld and defended in the future, even though he himself might only have limited voting power left. In order to grow, FairShares needs to extend their network to ensure a supply chain that is scalable, and they need further employees to help them grow the business. The first stakeholder group they need is the suppliers, both for the resources they use, but also production companies, as they will not be able to mass produce their designs. In the Standard Limited scenario, the initial search might be based on sustainable criteria, but production might still go to low-wage countries with low standards of employment rights and safety measures, especially later down the line when profits become more important. Founders often have to compromise. The relationship with suppliers is usually one of low engagement, where all parties involved seek the most profit for themselves in the relationship. In the FairShares Commons scenario, the company is embedded in an ecosystem of other FairShares Commons companies and can thus secure contracts with organizations that might normally not be available because of their stronger network. Additionally, through the steward's high voting power, it is not likely that company values are compromised for quick profits, but held up in the search for suitable suppliers. And the FairShares Commons has another unique selling point. Suppliers are invited to the table. They receive supplier shares that allow them to participate in the company's strategic decision-making as well as in the company's success. In order to grow, FairShares also needs to grow in terms of headcount. The Standard Limited company can only offer standard working contracts with pay rates below market average because they are still not profitable. Maria and Steve are still learning how to manage new hires in a startup context. They are making mistakes that drive much of that churn. This makes finding the right talent hard. Hiring comes slowly. Together with the high churn rate in the first few months, this means that the founders are always recruiting and have less time to focus on the core business. The FairShares Commons company has more to offer to talent than salary. Employees are seen as investors of their time and human capital and thus receive voting rights and dividends. Even though the company is not able to pay market rates, the sociocratic structure allows employees to feel a sense of autonomy in their roles. The adaptive way allows employees to develop themselves, as well as the founders. As Maria and Steve learn how to build a highly functioning team, the staff has everything they need to help Maria and Steve harness all the tension towards growth. The last important stakeholder group we are looking at are the customers. In standard limited companies, customer relations may be stated as an important factor for the business, but most of these relationships are purely transactional. Customers have a low engagement level with the company. Apart from generating revenue, they are at most used for passive data generation of their online behavior. In the FairShares Commons, however, customers are invited to engage and to take shares and get dividends. Since they now have higher stakes in the company, they can support in ironing out bugs. Everything they are putting in is recognized. They have the opportunity to steer the company forward and are enabled to give helpful insights into the company direction. In a FairShares Commons, business relationships are much deeper and more engaged than in standard limited companies. Inviting them to the table opens the door for more suitable and aligned stakeholder groups. Business success has become more likely with better talent, more loyal customers, and deeply connected suppliers. A year later, the business is starting to take off, and a funding round is inevitable to ensure growth. Sharon represents a VC fund. She wants to use existing structures and systems and change them so they do not harm the ecosystem they are embedded in. She also believes that the long-term gain is more important than short-term success. She works for a VC fund whose previous investment strategy was based on financial outcomes only. But now their new strategy changes this direction towards more regenerative businesses. It's Sharon's job to look for suitable opportunities that will still be profitable to show that this is the right approach. In the standard limited scenario, the VC fund and Sharon have a much harder time identifying promising opportunities. The two founders manage to convince the venture capitalist to invest in their company. However, they become a standard portfolio investment for the fund. In the FairShares Commons scenario, the decision to invest is made because of the incorporation as a FairShares Commons. The way the company works interests both Sharon and the board of the VC fund. The investment is seen as an experiment to observe this business governance model at work. After small-scale trials turned out extremely successful, the new funding sets the company up for scaling. The next general annual meeting is held to set the strategy for the upcoming years and beyond. In the meantime, Ed, our pre-seed angel investor, had to sell his shares to ensure liquidity as he hit a streak of bad luck in his personal life, and he sells all his shares to Sharon's VC fund. In the standard limited scenario, we now have one investor with high voting power. The funding board also decides to go for quick wins and wants to maximize their return on investment, even though Sharon advises against it. The decision is made to increase brand awareness and trust with customers so that the brand becomes more valuable without actual profitability. The board hints at Maria and Steve that their positions as CEOs are at risk if they do not agree to the new strategy. Ed's and Sharon's values already get diluted, and the founders need to compromise with the new investment strategy. In the FairShares scenario, there is only a minimal change in voting power, as Ed can only sell his investor shares that have a capped amount of voting rights. The shareholder board votes to grow the company only if the high sustainability standards can be kept. The decision is made to invest in the production company to allow a bigger scale of manufacturing. All shareholders are part of the investment on the condition that the supplier reincorporates as a FairShares Commons, which they gladly do with the experience from the past collaboration. The sales team gets a huge deal with a sustainable hotel chain. They sign off on FairShares furnishing all their new hotels globally. The deal receives big publicity attention. With this major deal in the pipeline, the value of the company has increased significantly. Sharon's VC fund decides to sell their shares to the highest bidder without taking into account any other criteria. In the Standard Limited scenario, FairShares is sold to a competitor that uses the brand as an addition to their portfolio to include something green, but the competitor does not follow the same principles and values. There is very little the founders can do to avoid the acquisition. They are afraid they might be removed as CEOs if they block it. On the FairShares side, the investors sell their shares with a profit. Again, business decisions are unaffected because of the fixed voting power of each shareholder group. There is no loss of regenerative outcomes of the business. Sharon and Ed, who are still following the journey of FairShares, see that even after their engagement officially ended, their values are even now protected. Henry is the CEO of Furniture Inc. He inherited the rather successful company from his father and has brought it to international success in his lifetime. He had always chosen the cheapest production countries and increased profit margin through that. As he grows older, Henry sees that his and his peers' way of living and doing business has caused a lot of harm in the world, and he wants to change a bit of that for the sake of his grandchildren. He knows that these are the last years he will be leading the company and is looking for a way to improve his footprint on the world. FairShares seems like the perfect opportunity, and he acquires them. He is especially impressed by their ambitious goal to create a fully regenerative supply chain, which he always brushed off as impossible in a globalized world. However, shortly after, a personal crisis hits the company. Co-founder Steve has an accident and tragically passes away. Maria and Steve together were still holding 1/3 of the shares, which gave them the right to veto important decisions in the Standard Limited company. Now Steve's descendants are selling his shares quickly to pay for the costs that his medical coverage and passing had produced. They sell to a private equity house. On the Standard Limited side, Maria is now the only remaining founder and finds herself surrounded by a board that has only limited understanding of the original values she and Steve were trying to implement in FairShares. Maria does not hold enough shares anymore to block any important decisions. For the FairShares Commons, once again, nothing changes in the overall distribution of voting power. Steve was holding both steward shares as well as his investor shares as a founder. Even with the passing of one of the stewards, the family sells Steve's investor shares with a profit, but they cannot sell his voting rights as a steward. The steward's shares are voted to go onto a democratically voted successor. Following the personal crisis in the founders' team, now follows a big hit for the business of FairShares. The hotel chain is sold off to a bigger competitor themselves. The deal with FairShares is cancelled in the course of this event. All of a sudden they face bankruptcy due to a high load of investment that went into that deal, but no buyer to cover for the cost. Currently, the Standard Limited company is rated as a zero-sum investment for the board. With the knowledge that the overall furniture market is in recession, the parent company decides to focus on core business and close FairShares for good. Maria was not included in the decision-making process and has lost all remaining power to veto any important decisions. Employees are informed of the board decision in an extraordinary meeting, some are offered contracts in the parent company, the rest loses their job. In the FairShares Commons, the investor shares could be sold, but closing the business is not an option without consent of other stakeholders, especially the stewards. The suppliers and customer base are still engaged and believe in the success of the company and its purpose. The past successes have shown that this business can be widely successful. They figure out a plan to still deliver success. The suppliers defer payment, knowing they have governing rights and will be paid out in the long run. The remaining customers decide to buy funds and stock to secure enough liquidity to keep the company alive. Staff members waive part of their salary and are working hard to find alternative customers. In the end, the FairShares Commons company makes it through the crisis. Maria, as a founder, decides that after helping the company through the hard times, she will step back to make room for a new CEO of the company. However, she will remain a steward. The parent furniture company sees over the course of the next few years that FairShares and its way of doing business is much more robust. After taking heavy hits in the recession themselves, they divert more funding and human capital into FairShares. A few years after the crisis, the company is embedded in a deeply regenerative supply chain that they actively helped create and in a FairShares ecosystem. To find out more, check out Graham Boyd's website, graham-boyd.biz, or the Evolute 6 website at www.evolute6.com. Also check out the new book by Graham Boyd and Jack Reardon, Rebuild, The Economy, Leadership and You, a toolkit for builders of a better world. You can order via graham-boyd.biz. For any further questions or contacts, feel free to reach out via Twitter. Credits for the emojis in this presentation go to Samson AR Zone and for the slide design to SlidesGo. Thank you so much for your attention and have a wonderful day.